You need to do what the others are not doing. And as a founder, you cannot expect the corporates to come to you. It is you that needs to go out of the box. You need to do something different.
Hi, everyone, and welcome to Climate Tech 360, where we connect with diverse voices in the climate sector to make informed choices in supporting the future of climate tech. I'm your host, Samia, and today I'm speaking with Jeppe Høier. Jeppe has 17 years of experience in tech investing and fund establishment. He joined Maersk Growth in 2018 to build up their corporate venture function as an investment partner. He's made supply chain, decarbonization, and fintech investments spanning from Sydney and Cairo to Stockholm and Silicon Valley. He's invested over $80 million to date with a 3.5x TVPI. Jeppe started his career as an auditor in PricewaterhouseCoopers and served 9 years as the CFO for Hardcore Capital and Sunstone Life Science Ventures. Jeppe is an expert in corporate venture capital, or CVCs, and he has a newsletter on this very topic, which I will link in the show notes. So naturally, CVCs are the topic of today's discussion. We talk about how CVCs are structured, how startups should engage with CVCs, how to find the right person to contact, whether it's for an investment, customer relationship, or setting up an offtake agreement. We talk about the evolution of CVCs, the difference between US and European CVCs, and why the decision-making process can take such a long time and what founders can do about it. And finally, we also discuss how to extract the most value from CVCs if they're an investor on your cap table. And now onto the episode. So I'm very excited to have this conversation with you because obviously you have so much experience. You were a partner at Maersk. You have a newsletter that's dedicated to teaching people about CVCs, but you're also not working at a CVC currently, which I feel like gives us the ability to have a more candid conversation.
Yes. For sure. Yeah, and thank you so much for having me, right? I think it's a pleasure to join. And also, as you ended your intro, right? For me, it's about spreading the word about everything good about corporate venturing. And then, of course, there are the elements to be aware of. But for me, it is the same as when you say yes to venture capital in general as a founder.
Yeah. Well, I think it's an important conversation, specifically in climate tech, because corporates have such a massive role to play in the energy transition. They are customers. That's kind of the obvious association, but they're buyers for the offtake agreement. They're strategic partners. They're investors sometimes. And the reality is that they have massive balance sheets and it eclipses what, the capital that venture capitalists have. So there's a lot to do in the CVC space. I think the problem is that it's a bit of a black box. We don't know what corporates are doing internally, and we don't know what happens, what the processes are, and how bureaucratic it can be when they're making an investment. All we could see from the outside is that it always takes a lot of time. So my goal for this conversation is for startups and also for investors who want to co-invest with CVCs or are interested in connecting their founders with CVCs. My goal is for them to get a better understanding of how CVCs are structured and then how to learn how to navigate that. So could we start with how CVCs are typically structured?
Yes. Of course, there's not one standard way for the structure of CVCs. It goes very much in as whoever is in dialogue with a corporate about understanding their decision structure to figure out, is it a balance sheet investor? Is it a single LP setup? How is it structured? If it is a balance sheet investor, who takes the decision? But it's always like that, right? Because if you are in dialogue with a standard VC, you have to understand, am I talking to an analyst, an investment manager, a principal, a president, or a partner, right? You want to know and understand who you are talking to. On the CVC side of things, right, you can't be in discussion with the CVC. Normally, they will have an investment committee consisting of the people that works for the CVC, but also from C-level from the corporate. It can be the CEO, the CFO, head of strategy, head of M&A. There's so many different ways of doing this, right? So it is, ask about the structure, it's not uncommon. And also understand, where in the corporate venturing pipeline are you, right? How far have you progressed before an investment structure? Ask the CVC, what is the process from initial dialogue till I receive money, right? It's a standard dialogue. So just go in and ask that.
So in my experience, I've at least in the conversations I've had personally, and then even on the podcast, I've seen kind of two different types of structures. And one, so for example, when I spoke with Syngenta, they make small investments specifically for return purposes. They are not in the market to buy this company. So they have a separate M&A group, but the goal isn't, we're gonna make an investment ultimately to buy you in 5 or 6 years. But I've also co-invested with CVCs that have invested with the goal of potentially, there's a specific strategic fit. So their aim is to buy the company potentially down the line. Is that a safe way to categorize the two different types?
Those types are out there. Copenhagen Business School just did a study on Nordic CVCs and their behavior. One of the findings was that 82% of the investors in the Nordics are there for strategic reasons. So I think, it's not uncommon also when we talk about the challenges of these, first of a kind investments, the folk investments, is that, if you go in for an LOI or similar, right? I think that should be ideal for the founders to go for. And there is something excellent about having a CVC below a 5% threshold. You can, of course, always design your investment documents in a way where you can eliminate information flow to the corporate, right? Because a lot of VCs and also founders, they have this understanding that the corporate will use the information to negotiate.
Yes.
I come with a long background also as a CFO for a life science fund. There it was more of a blue stamp if you had a Sanofi or a Novo Nordisk on your cap table, because it was a potential buyer. But we always kept them below 5% because there's nothing as excellent as keeping your buyer close, right? It's easy to reach them to understand, are they interested or not? So I think, I was part of investing into a Nordic unicorn in the sustainability space for Maersk, right? And then, we had a commercial discussion between Maersk and the startup. And there, we just decided that, I would leave the boardroom. I was not part of any discussions and so forth. So, and that was not a challenge for me. So I think it's also a lot related to how does the people around the table behave? Do they have this understanding of how venture capital works? Because also where you came from earlier, a lot of, senior managers, presidents at corporations, they don't understand the startup ecosystem. And that is, back to my newsletter. It's about teaching the next generation of leaders how to use corporate venturing as a tool for taking their own company to the next level.
But how do you do that? I mean, I've worked in corporates for most of my career, and information doesn't flow that way from the lower levels up to senior management. It comes down from senior management. Senior management decides, okay, are we going to do this or not? And sometimes they have a CVC as just like option value and they don't really take it seriously. And sometimes you have a regime change and a new CEO comes on and they're like, no, we're really serious about this. So how are people supposed to go about educating senior leaders about CVCs?
Yes. So the way that I normally explain this is that in corporations, you should see a CVC as an organ transplant. It is something from the outside that is put into the organism, and the organism, the body, is the corporation. It is so important that the body takes medicine, and the medicine should be understood as an information flow from the head to the body, with the head being C-level and the board. They need to communicate and take this medicine to avoid the body fighting this new organ. And that works. So I transfer that directly into a strategic document. The corporation should write down, why is it that we do corporate venturing? Why is it that we go into this? What is the strategic rationale? And how do we keep informing the body that this is something that is important, right? So I think there's a lot of information flow, and then be aware, if you are, the CEO of a large corporation, that you also need your employees to have time to work with startups, right? So it shouldn't be on top of your daily job. It should be something that can be done within your work hours, right? So I think it's a quite good way to look at it.
Okay, so as a tip just to founders, if you are getting a term sheet from a CVC, the goal should be to limit access to information rights potentially, and to keep the ownership below 5%. Is that what you're saying?
I think that is one way to do it. I've been in with ownerships of, 15, 20% in companies for Maersk, and that is not a challenge as long as you behave as a standard VC. If you are scared, so to say, about having a CVC on your cap table, and then of course, then you need to put things into your legal documents that can take care of specific informations and information right and specific decision rights. So, but for me, it has never been a challenge. I think it's more convincing co-investors in the VC space that this is okay. I think I was kind of lucky because people knew me from the ecosystem that, Jeppe has been around, he has been working for this VC before. They behave in a standard way. And then luckily I had the opportunity in Maersk to install the knowledge I had with me from that VC. We operated with external lawyers to avoid avoid is a strong word, but to avoid a little bit of the Maersk lawyers, because they were used to doing commercial agreements. We needed somebody that was used to do minority investments, and that's a different game. So I think, it is, there's a design for everything.
Yeah. Rightly or wrongly, one of the perceptions that people have about CVCs is that everything takes much longer. So the time frame for getting a term sheet, negotiating a term sheet, not just that. I mean, just when you're even engaging with a corporate, sometimes you have to sign an NDA, or the startup makes them sign an NDA. And that process itself can take a really long time. And I have experience of working at corporates, and I kind of understand why everything takes so long. It's just more bureaucratic. And when you think about big corporate and all of their strategic initiatives and what they're working on, and especially if it's a public company, a CVC is usually not high on their priority list. And so it could be that investment committee meetings aren't happening regularly, or people are just not focused on it because the corporate is focused on something else, like an earnings release or an acquisition or something like that. When you ask CVCs about this timeframe, they'll usually give you a few examples of deals that they did really quickly. But we know from a market perspective that that's pretty unusual. So can you explain first, maybe give us inside perspective on why it takes so long, and maybe some tips on how to potentially accelerate the process from a startup perspective?
It takes so long because when you have a huge organization, Maersk was more than 100,000 people. There needs to be structures. You cannot operate the same way as a startup. And that then comes with this, it takes a lot of time. Again, it's also from the CVC side about how much do you push, and has the CVC made some good structures. For Maersk Growth, we had our own decision structure, so we could do the investments. What took a long time was when we had to do commercial collaborations with our portfolio companies, because then we got into, the Maersk kind of, container ship, and it does not turn quickly. It just does not. But again, if the CVC has done their politics right, then they know how to accelerate. So I think there's also an understanding from a founder perspective when you talk to a CVC, how long time have they been operating? Is this a CVC that is 10 years old? Most likely not, because the average lifetime of a CVC is 3.7 years. But there is an understanding. It's the same with a VC, right? Is this a first-time manager? Is this the first time they do an investment, and so forth? So to understand those structures are important because, as you said, yes, there's Merge Growth's most speedy process, 8 days. Most speedy commercial collaboration, the same. But we also had one that was a 3-digit $1 million agreement, and it only took 3 months. And that is very, very speedy in a corporate setting.
Right.
It could have taken 9, 12 months because it's a lot of money. And as a founder and a startup, you should remember that there's a lot of risk associated with the transaction from a corporate perspective. There's brand recognition. That is significant. They do not do something that turns out badly for them. And they shouldn't, frankly. But again, they should be open to collaboration because that is where they learn and gain a lot of knowledge.
So in your examples, in your experience, you don't have to name the companies, but what's the difference between a deal or your due diligence on a deal that took only 2 or 3 months versus a deal that took a year? Is it that it was something that was right within Maersk's wheelhouse and you knew it and you didn't have to go into the details in terms of doing due diligence? Or was it more like serendipity? Like, it was the summer and corporate wasn't really focused on other things. And so we got to investment committee early.
Yeah, no, I think it depends on so many things, right? Because if it's a key pain point for the corporate, they will solve it quickly. But any customer of a startup, they will solve their issues quickly if you are addressing a really, really important area of their business. Then everybody will move. So I think it's related to that part. And then, of course, as you said, vacation, summer is coming up, nothing is happening. But the same on the VC side of things, right?
Yes.
For me, living in the Nordics, I was used to, it's part of July that we are out, but then we do business, right? But now, basically all of Europe in VC space is closed in August. And if you're lucky, you can do a deal late September. And everything is happening around year-end because there's a lot of people that has a budget that they need to use in the corporate world. So there are so many elements to be aware of. And that is also why, as an investor, I like second-time founders because they have tried it once before. Or I like what I call an operator, one that has worked in a large corporation or a startup. Because, they are mature enough in their development that they understand. And they also take it as part of their decision, right? They know, okay, now, it is May 22nd. If I have not my deal closed by mid-June, right, I will most likely not have this deal done before after the summer. And that is mid-September. So I think all these elements are in there. But again, back to kind of the key of your question. Yes, if you solve a problem that is something major for the corporate, the deal will close in a speedy way. Or if it's a smaller euro decision, it will also go fast. Remember, there's all these thresholds in corporations, right? I could, with my title, move investments up to, I think it was $1 million. So that would be speedy, and our managing partner could do $5 million. So it's quite easy to get it through.
So is that your way of saying that if the corporate really wants to do the deal, then they can do it quickly?
Yes, if they really want it. But again, it comes also with the maturity of the people around the table. Because if you have been part of doing, CVC deals for 3, 4, 5 years, you have seen all of it. You know your leaders, okay, I know this deal is coming up. I want to close it before the summer. Well, I probably need to eat lunch with the corporate CFO to make sure he can release the money and knows it's coming. So for me, it is playing the politics that a lot of founders and VCs do not understand. And
Yeah.
I love I love the European VCs, but again, they are not that connected in corporate life. They don't understand. Well, they intellectually understand it. Of course they do, but the network with the corporates is limited. It's a little bit
It
different
really
when you
is.
get to the US. The VCs in the US, they know to get to an exit, they need to know the head of M&As at all the large tech companies or all the large pharma companies. If you're in that space, right, you know where to go to. But the European mentality is a lot around, we need the US investors to come in anyway and take the growth rounds, and then they will take care of the exit. So the collaboration with corporations is quite new in Europe. And I think it comes a lot also with where you focus, right? All this sustainability. We need investments in CapEx, or what we call folk investments. And where is that going to come from? Right? It comes with this risk, and corporations are part of the solution to solve this challenge.
Yeah, that's interesting. I mean, I will echo that sentiment. It is very siloed here. I can't speak to the US. I'm not sure how it is there, but it's very siloed even within venture capital. So you'll see early stage investors speaking with early stage investors and growth investors speaking with other growth investors. There are communication gaps along the line, but it's particularly a wide gap when you consider VC versus corporates. We don't attend the same conferences. We don't go to the same events. We never cross paths.
No, we don't, but we do more and more. I think I was lucky to get into, in the beginning, I called it logistics tech. People call it supply chain, mobility, and so forth. And it was just when a lot of great companies were made, right? Forto in Berlin, Sender in Berlin. So I was part of the wave, right, when venture capital went into supply chain, and there I could use my connections. But in general, also for how do you find a CVC? For example, the large CVC in the former Statoil, Equinor in Norway, right? They don't have a homepage. You cannot find them.
Yeah.
Right? You cannot even find them on LinkedIn because there's nothing called Equinor Ventures, and they have been around for decades. You cannot find them. So unless you really go in and study and do a little bit more effort than normal, then you will not find them. Especially in the sustainability tech, right? We have large conferences, the Drop coming up in Malmö. I think it's right after the summer. There you will see a lot of CVCs because they are interested. Right? They are interested in sustainability. They know they need to be there, but there's something about the maturity level also, because the corporates will take some of the risks that the VCs will not take. And that is more the hardware related investments. They will do them.
It's interesting that you say that about the Drop, because I've been to the Drop their inaugural year and I went last year. And I didn't see a lot of CVCs there. The European community is really small as it relates to climate tech, and investors and even startups. We all sort of know each other. And I didn't really come across a lot of CVCs. So I guess that just shows you that even if you're at the same event, you're not aware of the other's presence. So I have two questions related to a couple of things that you just said. One, let's just start with sticking to the same theme of categorizing CVCs. If you were to generalize, and I completely understand that generalizations are not always accurate, how are European CVCs different from US CVCs? So I did a quick search on the most sustainable companies, and the top 100, I think 40 of them were European companies. And I would imagine that those companies like the Ørsteds and Vestas of the world have a CVC arm. So What are your thoughts on how European CVCs are different from US CVCs?
Yeah, I think what I will use here is that I was speaking at a large university a month ago. I got a similar question from the audience. The question was something like, does it even make sense to do CVC in Europe? And my answer to that question was, It was a similar question the European VCs got 15 years ago. Should we do venture capital in Europe because the Americans are just so much better at it? I think it comes back to also why I do my newsletter. It is I want to spread the word about everything great for corporates to do venture capital. But they need to learn, because in the US you have companies like the Googles and so forth. They used to be startups. You kind of know that it will become great, but we don't have those stories in Europe, right? Europe comes from, a trading background back to, Christopher Columbus and so forth, right? It goes so far back, and we're just not there yet, but it will come.
So then would you say the difference is really in the maturity of the industry, that the US is just more mature and CVCs are more prolific?
Yes, it will take time. No, we need more success stories, but it's the same for European startups. It's the same for European VCs, right? They are, we have a lot of unicorns in Europe now, right? The UiPath is the Spotify's and so forth. Great stories, right? We have excellent investors, the North Zones, the EQTs, the HVs, and so forth, right? There are so many in there that have done an excellent job. Now it's time to also move the CVCs into that space.
It's interesting because some of the CVCs that I know that I'm in touch with, I feel like I can get so much insight into the industry through them. So Maersk, companies like Ørsted, or even Equinor. I think there's another level of complexity with companies like Ørsted and Equinor because they're also partially owned by the government. So they're even more restricted than a regular corporate CVC.
Yes. They are. It's a lot of the framing, but it comes back to what mandate has been given in how they control and operate their CVCs. So I think, I've seen great stuff by the Ørsteds and especially Equinor. I've seen a lot of good stuff coming out of them. Also, Scania has a great CVC. Well, that's a listed company, so not really good in that comparison. But I think it depends on the setup.
Yeah. Okay. So going back to the drawing board, if I'm a startup and I'm looking for an investment from a CVC, where does the startup even start? Should they? I know that if a startup is looking for investment from a venture fund, they can Google climate tech funds in Europe, and there's lots of Excel spreadsheets that lists out every single venture fund in Europe, and then they sort of look for warm introductions, or they cold email them. Is it the exact same process for a CVC? Do they sort of look for those databases or Excel spreadsheets where all the CVCs are listed, look for a relevant contact, which can be a lot harder to find, right? Because in VC, it's usually just first name at something.vc. But finding someone's email address within a corporate is even more challenging. So what's your advice to startups that are trying to navigate this landscape, trying to get investment?
Yeah. So I think a couple of things, and I'll get back to the answer for your direct question. I think when you are a founder, I think you always look for what value creation do I get from my investor. So on the VC side of things, one thing is that, well, I want money from Creandum or Balderton. But it's not really Creandum or Balderton you want. You want a specific partner within that venture capital firm that has done investments in your space before. You want to understand who it is, right?
That's very important.
Otherwise, it's just a money game. And I think the same when you then start searching for a CVC, right? Then, okay, what space am I in? I did an investment in Onomondo here in Copenhagen. It's IoT connectivity. Well, it was not intuitive that they would go for Maersk as an investor, but with all the reefer containers, so the cool containers there are on ships, right? They need an IoT device. They need a SIM card, right? Okay, it makes sense. Let's try to get Maersk as an investor, right? So I think you need, as a founder, to understand what value is it that you are looking for. If you can then not find a CVC within that specific corporation, I would aim for the strategy department. at the corporation. Head of strategy or VP of strategy, they know what's going on inside of the corporation. That would be my go-to, always.
Okay. So for a startup, they should look, if they can't find the CVC, then they should look into the head of strategy. Is that the same for offtake agreements? Because offtake agreements plays a huge part in a climate tech, sort of a hardware company's journey. And in order to raise funding for these first of a kinds or nth of a kind plants, they need to secure an offtake agreement in order to get the project financing. That is even more of a black box than trying to find a CVC, because a lot of the time there's like one or two people in the organization that's focused on offtakes. So how would a startup find the person who's dealing with the offtakes?
I would still go through the CVC. I would hope there is a CVC within that. Otherwise, it comes through kind of expert panels. Then you need, for example, in Maersk, a lot of the offtake agreements were done within what I call the green fuel space. So whatever you put into the engine of a Maersk ship, then it will kind of be the people designing the engines and understanding how that works, right? So you need to be able to get a hold of them. And that is a challenge. Luckily, within Maersk, there was a division that only did that, right? But then you just have to start to do your magic. And that is also what kind of puts the very, very good founders apart from the rest, is that they will never give up, right?
Right.
Being a startup founder is more of a religion, right? It's not a job, in my opinion. You kind of really, you really, if somebody pushes you over, you get up and you walk, right? You just keep on going. And it's not for everybody to be a startup founder. So I think you really have to push.
So your recommendation would be same thing, try to go through the CVC and hope that there is someone that you can find the CVC group. And if not, then find the head of strategy and email them and say, how do I get to the person that deals with offtake agreements for XYZ?
Yes. And then again, there's a lot of industry events, conferences where you can go.
Yeah.
And we see more and more startups getting into these big industry conferences. But that is where you have to just walk from one booth to another and just find the people. Right? You might also, if you go there, find a corporate you didn't know of that is, within the space you want, right? So it is being, open-minded, see what's out there, and just push hard through these large corporates.
Yeah, I went to the Economist Sustainability Conference. I want to say it was like earlier the beginning of this year sometime. And it was all corporates. So for any startup that's listening to this in climate, there were 3 days actually. The first day was specifically around energy. The next 2 days was around sustainability. In particular, at that energy conference, it was all corporates and there were no startups. So if you're a startup and you were at that conference, you would have unfettered access to everyone that you want. And the perception with some of these conferences is, it's economists, so it's going to be really big. And it wasn't. It was at a venue that was easy to navigate. And for the energy one, there were round tables where you can really make direct connections. And every major chief sustainability officer was there. So my recommendation would be to go. The problem is the ticket prices for those conferences are so expensive for startups because they're usually over like £1,000. So I would reach out to whoever's organizing, see if you could get a discounted ticket. If you're an early stage startup, sometimes there's ways to do partnerships or sponsors and get a free ticket, but I would highly recommend that. It will give you such an edge over other startups because you have this free access to corporates.
It's an excellent advice, right? You need to do what the others are not doing. And as a founder, you cannot expect the corporates to come to you. It is you that needs to go out of the box. You need to do something different. And some of the people that I admire a lot is Mickey Wachs from Forto in Berlin that I ended up investing into. His willingness to go really, really far inside the Maersk organization, also without my help.
Yeah.
Sometimes it might have been a little bit too much for me and created some challenges. but that is the push you need to do. And the same goes for some of the I know VC, the Heilemann brothers, right? Excellent in understanding this and pushing through, right? You really, really have to push. You cannot sit and wait. So you really have to do this.
What are some of the advantages of having a CVC as an investor in climate tech based on your experience at Maersk? What are some of the things that you did as an investor that traditional generalist fund or even a climate tech fund wouldn't be able to offer the startup?
So the way that I normally describe the value creation for a founder getting a CVC on board is that you will get access to assets, brands, customers, data, and expertise. So there's this whole box that you get from taking a CVC on board and playing in that, but always the brand. It's kind of if you have one of these whales on your pitch deck when you go out and sell, other customers will listen. Okay, this huge brand is a customer of this small startup. There must be something in there. So as a CVC, the best thing you can do for one of your portfolio companies is to bring revenue to the table. So also operating the CVC, understanding who are your colleagues in the corporation, who are the key account managers, how can you benefit of their knowledge, introducing customers to the startups, right? So it's a lot of work inside of the CVC to get the full value out and hand that over to the startup. And that is where you get a lot. So I think that's also some of the things that you can ask as a founder, getting a CVC on board. Do you have the potential to bring me customers, and how would that work?
That's a great point. I mean, that is a superpower. As an investor, if you can help the startup generate revenues directly.
No, I think there's a lot when you look at the VCs, what they're excellent at is especially hiring. A lot of them have a really, really broad network because they have hired for so many years, right? That might not be where you ask the CVC for that failure, right? There's something about orchestrating the next finance round. Use the VC for that. But when you talk about the CVC, right? Well, if you need to understand how to do excellent reporting, you might want to talk to the CVC, right? And ask, do you have somebody internally that can host a roundtable? One of the things that we actually did while I was at Maersk, right, is that we had our chief strategist to come in and do kind of, what is happening within supply chain twice a year. And that didn't matter if you were a procurement company or whatever, right? It was, a guy or a lady that understood economy in general. And just talking about the economy, right? Everybody gets so much out of that. So, the opportunity operating a CVC is also, okay, how can we make a difference and how can we win, some of these startups when you are in competition? Because I think that is what the CVCs do not understand, is that they are in competition to win a deal.
Yeah.
And a lot of the CVCs, they will also get bad deals, right? Because they get kind of the leftovers.
Another advantage I think that you can have as a startup if you have a CVC on your cap table is actually costs. So the first thing I will say is that the startup has to ask the CVC. I've seen scenarios where I've been in deals with other CVCs and the startup hasn't asked. You have to ask. The CVC isn't going to be proactive and say, here's a whole menu item of things that we can offer you. The startup has to be like, hey, do you have an expert in this? Could we use their advice on XYZ? Sometimes they have legal teams that they can ask a quick piece of advice to that saves them in legal costs, which is massive for the startup. Sometimes there'll be a sponsor for something like an expo, and that way the startup can go and have a booth without having to pay. These are all really expensive things, especially for an early stage startup. So I think there could be some, the brand stuff undoubtedly is the number one, but I think there can be a lot in the way of cost savings as well for startups if they can properly leverage the skills that a CVC has.
I fully agree. It's a lot. I recommend it both ways, right? It is spending time with your stakeholders, right? You're not, as a founder, you're out fundraising, but a lot of times it's about, finding the money, because that is what you do in VC world. And then a lot of, VCs are good at having, weekly meetings or every second week or so forth, right? But when you operate with a CVC, you might want to spend a little bit more time. Just understand, how is the corporation working? Also, to some of the questions that we have discussed, what is the decision structure? We will have a funding round coming up in 18 months. How should we prepare for that? How can I help in, presenting to your key stakeholders to basically dress everything up? So it's just being aware of where you're going and what you want to get out of the collaboration, because it's not only an investment from a CVC, it's a different collaboration. And especially when we are in climate tech and you want to build the relationship, you might want to go for an offtake agreement. But if you want to do that, get to know the stakeholders beforehand. Invite them, deliver information about what's going on in the startup world, make sure that is transformed into the corporation, play your investor great. It's some of the basic rules, right? If you want to convince people to go your way, right? You have to play them good. And I think it goes the same way here.
Another piece of advice I would offer to startups is, if you are working with the CVC, ask to talk to other portfolio companies of theirs so that you can understand how they were value added to those portfolio companies. So for example, if you're a climate tech startup, you can ask the other portfolio company, did you secure an offtake agreement? How did you navigate? What else have you gotten from the CVC? Just to get a better lay of the land.
Yes, I fully agree. Always do your DD. Whether you are a founder or an investor, you need to understand who you're working with. So for me, the reference calls, they are a must both ways. I think, a lot of the second time founders out there, right, they also get more and more picky about what investors do they want in their cap table. And the only way to figure it out is to talk to the people that have done the investments before and who they collaborate with.
Has the CVC structure and landscape changed in the last decade? And do you think that we're going to see changes in the next decade? I think that in climate, we're really seeing the pivotal role that corporates can play and how they can be, the off-taker, the customer, the brand builder, but also critically what you were talking about with the hiring. A lot of these climate tech startups don't have the commercial expertise to scale. So they have, two sort of very technical scientists that maybe start, and in the early years, they have a very thin team, but in order to scale, they need the commercial expertise. And often at the CVCs, you have that kind of commercial expertise. So do you see that the CVC landscape sort of evolving and changing going into the future?
Yeah, and it changes a lot, and it changes all the time. It changes too much, in my opinion. I think it's always sectors that moves, and especially right now, everything climate tech needs to be touched, right? I think what I try to do in climate in general is to understand whether it's a CVC or a VC, is whether they will do deep tech investments. Because if you take the broader VC landscape, they will all say they're climate investors, but they only do software. So I think I really, on my wish list, there would be, okay, are you a deep tech investor in the VC space, or do you only do software? Then I think, it would be a lot easier also to understand, who can actually help me as a founder with creating an offtake agreement. Because a VC that is a deep tech investor, they might have been part of doing an offtake agreement before and understands how an offtake agreement works and what it looks like, because that's a whole new thing for a venture capitalist. is to see a commercial collaboration. So unless the VC comes with a background as a founder or an operator before, if they are, I'm an auditor by background, right? If I had not worked for Maersk, I would not know what an offtake agreement was. I would probably never have seen one. And would not know how to negotiate it. So I think there's a lot in there. I think when you talk about the development of the CVC landscape, right, there is this challenge with the average lifetime of 3.7 years. They will change. Right now, there should be, and there's a great opportunity to create CVCs when you have valuations a bit down, right? It's not you're not coming in on a high where you normally see a lot of CVCs going in. That is when, there's a lot of money and a lot of cash flow in the corporations. Then they're like, okay, let's create a CVC, right? It is now you want to get in because valuations are low, and then you can show the value uptake to your CFO and CEO and so forth.
3.7 years is not a very long period of time. Does that mean that they actually just shut down under 4 years, or do they change and restructure?
Either or. You see a lot of CVCs pivot into, they might have been a little bit of an incubator for a start, moved into direct investments, what we here call CVC, moving into corporate clienting that is more, the accelerators of the world. So they kind of go around, but the ones that have a CVC, that is 3.7 years, and that is such a short time. And there's so many reasons why it is like that. But we talk about different gates, right? The first gate is right around 3 years, is where you need to show financial performance as a CVC. If you do not have that, then that is a major decision to close it down. If you then survive that gate, it's around year 6, where you will then have the whole strategic decision again. Why is it that we have a CVC? So back to where we actually started this strategic document. We are doing an organ transplant. Why are we doing this? Because when you get to year 6, if you're unlucky, the corporate might have changed their CEO 2 or 3 times, and there is a new chairman. Yeah. So there's nobody left from the original decision to create the CVC, and why that is important. Then you have been in a downturn, right? You got a new CEO in, they needed to do cost cuttings and so forth. They're looking at the CVC. Well, this is just a cost burning department. Let's close it down. It does not have an influence on the top line, but that is so short-sighted. And that is where you have the market dynamics of a CVC having a bonus for the next 12 months. You need to hit these KPIs, right? And if one of the KPIs is bottom line, I would also kill the CVC.
Right.
No doubt.
Yeah.
So I think it comes with this, let's spread the word of all the great stuff about, new technology, and especially within climate tech, right? It is so important that we all move this space.
Yeah, they have an outsized role to play in climate tech. So they need to survive longer than 3.7 years for sure. What about having corporates as LPs for climate tech venture funds? I've been told that it can take much longer to raise corporates, I've been told that it can take longer to raise capital from corporates for venture funds. And there can also be competitive issues when you have corporates as LPs. But I know a lot of people that work at CVCs where they also make direct investments into funds to get better deal flow. So what are your thoughts on that?
Oh, I have so many thoughts on that. I think Nokia Growth Partners, now NGP Capital, they got kind of into investing. And if you think about setting up a CVC as a corporate, there is something great about doing a couple of direct fund investments to learn, right? Because what you will get is you will get an introduction to how is the investment process? How are the different investment documents? What do they look like? What are the terms you give towards startups and so forth? So there's a lot of learning, right? But then you need capital for that. So I think that's an excellent part. Then I've talked a lot to Crispin like at EnBW in Germany, the energy company. And, they are doing direct fund investments, but they will only do it with funds they have co-invested with a lot of times. So if they know the VC and the partners there and understand the strategy, and it is, you cannot be a sector agnostic VC and go to a corporate for money. Does not make sense. But if you are in a vertical, and also where you started by, so if you are at climate tech, deep tech fund, okay, let's go out to some of these corporates that have stated clearly that they do fund investments and they are within the space we want, right? Because what you also get as a VC there, if you get that money, is that, okay, here are somebody that can actually take the growth round if they want to, or they can be a buyer. So I think that is also working a little bit with the exit strategy as a VC, taking it to the next level, right? When you do your fund pitch, right. It's kind of okay, because it's a classical LP question. What is your exit strategy, dear Mr. or Mrs. VC, right? What is it that you do? And I think here there are some excellent ways and as we also talked about, getting knowledge about what's going on in the industry.
That's interesting. So pro tip to VC funds that want to raise capital from a corporate, start by co-investing with the CVC.
Yes.
So they can get to know you.
Build up the momentum.
Yeah, it's a relationship. It's always a relationship building exercise. So I think we've covered everything. I mean, my takeaways from this are really, as it relates to startups and founders, find someone in the organization. It might take a while. Maybe you don't get the right person at first through LinkedIn or an event, but keep searching. Go for the corporate venture group first. If you can't go into strategy, that's the case if you are trying to get the corporate as a customer, or you're trying to get an offtake agreement, or if you're trying to get investment. Expect long timeframes. There's probably not that much that you can do to accelerate the process. And just go to events where other startups aren't going. Don't just go to the events where every other startup will be. Go to the events that cater to large corporates.
Yeah. And I think, as you said, it takes stamina, right?
Yeah.
So for me, it's also a good advice to founders within climate tech. Make sure that when you fundraise, whatever amount you raise, make sure it lasts for 24 months because it's going to take a lot of time.
Yes, absolutely.
Right. It's not a speedy software thing, right? Make sure that you have money that lasts and then, have the stamina to keep pushing.
Yeah, especially in this market. I tell all the startups when I hear about their fundraising plan and they say, this raise should get us to 12 months of cash runway. I was like, well, then you better start raising right now for the next round because you need 24. Yeah, that's great advice.
That accounts for founders and VCs. You're always in fundraising. It's the same game, right? We just tend to forget, but you need to be fundraising all the time.
Yeah, always be fundraising. Well, Thank you, Jeppe, for this conversation. Thank you so much. And I'm going to link your newsletter in the show notes as well so that people can find it and educate themselves on corporate CVCs. And that is it for today's episode with Jeppe Høier. If you found it useful, please subscribe and write a positive review because it helps people discover the podcast. Thanks for listening and catch you at the next one. Bye, everyone.